Okay, folks, welcome back. This is our weekend review for March 7th, 2020. All right, so we're looking at the economic calendar. This is what's on the horizon for next week. And I'm not going to jawbone in. I'll just leave it on the screen for a moment. Okay, if you need more time, just pause the video. Otherwise, I'm going to continue. All right, so we are looking at the dollar index. This is our daily chart. And as you can see, we've had a complete erosion of the dollar index. Last Wednesday, I was looking for a willingness to want to get up into this fair value gap. That would have given us a real nice premium array to trade short and go long on foreign currency. It was just simply too heavy. We have 1, 2, 3 fair value gaps on this chart. And before I go into discussing more of the commentary for this week to come, the charter members that are familiar with the IPTA data ranges, I want you to refer to this one, and this one. 2 of them are expired and 1 is not. Okay, so for your homework for charter members, I'll post a chart with annotations on that this week. It probably won't be till Tuesday. All right, so with the dollar index daily chart, we've completely blown out the sell side liquidity here, and I said if we got down to here, it would expand and make a run for this low over here. We did in fact do that. My personal view is it's starting to sink in with the ramifications of this virus. Okay, the folks that have been in denial about it, saying, well, it's just the flu, it's this, it's that. Okay, I'm not a scientist. I'm not arguing the validity of whether or not it's going to wipe out the entire population or a large degree of it like the Spanish flu did. But there's an eerie similarity, okay, to the Spanish flu that needs to be reminded of for those that are listening. In the time when the Spanish flu was going about, okay, they were doing press releases saying that don't worry, it has a very low mortality rate, but it wiped out millions of people. So I'm not here trying to scare anybody. I'm not here to be doom and gloom, okay, but I am trying to be a voice of reason here. I am focused right now because I don't know what the outcome of this virus is going to be. Is it going to fade away when it gets warm? I don't know. I get a lot of emails about all this stuff. I don't claim to be an authority on it. Okay, what I am versed in is reading the tea leaves, okay, or the reactions of people. I know the human mind a little bit better than the average person, and I know what they're going to do before they do it. I know what they're being primed to do in the marketplace. So my focus is and has been trying to get you in line with what I see as a reaction in the public. Okay, so the states now, I was looking at the news wires for the U.S., and there's multiple stores in New York now that have crowds of people waiting out there, waiting for the doors to open up because they're making a run on the stores. It's been about 2 months almost since we started talking about this virus, and I've been trying to get your attention to get your essentials at home. This is probably going to be the last week you get to do it, because it's going to be pretty obvious this week, I think, that we have a real problem here, not just in the States but everywhere else. And what I mean by that, I think you're going to start seeing the numbers exponentially grow. We started in the beginning, a week ago, where you couldn't get a decisive number of how many people in the United States actually have it. If you listen to Pence, it was one number. If you listen to the CDC, it was another number. If you listen to the local news out of Seattle, it was a completely different number. Okay, so I'm going to err on the side of local authorities, because if it's making their news wires in local areas, chances are it's probably the most accurate, because personally, I don't believe the CDC, and I don't believe anything that's going to come out of our U.S. administration. And it's not because I hate Trump or I love Trump. It's just they're manipulating the information because they know what's coming. And eventually, the steam that's boiling under the lid is going to overflow. And people are just going to go, to hell with this. I'm going to go out and buy whatever I got to get, canned goods, ammo, just whatever. And when that stuff starts dwindling down, or companies can't operate, because that's what's coming. That's exactly what's coming. There's going to be, a forced quarantine on certain things, and companies are also going to quarantine for their own sake. They're going to say, hey, look, don't come in. But not every country or company or business can operate with people staying home. The United States is a very service-oriented nation, and most of the jobs, and this is the reason why most of our jobs are very low-wage earning positions, they're all servitude, in the sense that it's all providing a service for someone else in the form of fast food, restaurant, that type of thing. And we are a population that is going to get hit heavily with this. And that's what we're seeing here. We're seeing a dramatic repricing by the Fed that, the dollar's in real trouble here. Personally, I think we could go as low as 92 cents in the first quarter to second quarter. We could probably see it drop down that much. Below 92, I don't know. Right now, that's the visibility I have going into around June, mid-June, something like that. Now, obviously, if we start to just completely break lower and drop precipitously, then I'll have to revisit the 92 level. But I think that's probably where we're heading next. Now, it doesn't mean it's a straight shot straight down from here. Can it do it? Yes. I'm wanting to see it try to come back up into some level of fair value. And that would be taking this fair value gap over here, and you can do this on your own chart, extend that out in time, and it would also rebalance at 96.50. So if we can touch 96.50 or very close to it, that might be another opportunity for another wave of selling. And I do believe that we're probably going to see a lower low on the equities market this week as well, because the numbers are coming out now. People are dying. They're getting sick. Whether you want to say it's just the elderly or not, people are going to see that and say, well, that means I'm going to die of it, okay? Or my family's going to die of it, and God forbid, in Jesus' name, that happens to any of us, or anyone for that matter. But that's the psyche right now. Everyone has that wavelength, if you will, about this entire virus. It used to be, it was a joke, it's just a flu. But if you look at the data, it's doing a little bit more than what everyone would have you believe. And it's spreading. And we're going to be met with some real hardships here. The markets are going to be very knee-jerk reaction, probably for the rest of this year. That creates opportunity, but it also creates a higher level of risk. So if you're listening to me and you're saying, I'm going to take some trades, okay, just be mindful that you could really blow yourself out with a move that would just come out of nowhere because something releases in the news wires that completely shocks and stuns everyone, and the banks, offset that sentiment, okay? And we are in a territory where there are swans still in the pond. Okay, I don't think this is the big thing. The big thing is still coming. And I don't have my finger right on it yet, exactly what it is. But I'm not ruling out martial law. I think that's what's ultimately where we're going with this. And in the longer term perspective is once the initial dust settles with trying to combat this is ultimately going to lead to war. And it's going to be it's going to be a nation against China. And is it going to be us? Is it China going to be saying, we released it over there to hurt them and remove the likelihood of them overtaking the U.S.? Or is it going to be China saying that Israel had something to do with it? These are all conjectures, okay? I don't have anything to say this is the reason why I think that. I'm just thinking about what could possibly be used to spin this into a war. And that's what I've been thinking about, okay? How I have, and again, it's not up for debate. I'm not trying to get into a debate with any of you. I don't want to hear opposing sides or anything, because that's not what I'm saying. I'm just giving you my mindset right now. And something like this is just going to be an invitation for a war, and I think that's where we're going. And we'll have to cross that bridge when we get to it. But nonetheless, that's pretty much what we've seen here visibly in the dollar index, the complete repricing by the Fed to take out this low here. So any large long-term funds that were bullish on dollar, they have been nixed. Okay, so they're completely out of the game now. We're going to drop down to an hour chart. We'll take a look in here. All right, so we have a fair value gap here in the form of a SIBI. Price comes back up into a consequent encroachment, and also institutional order flow entry drill right here. And then price starts to erode going lower, clearing out that long-term low that we've highlighted on our daily chart. You want to use these fair value gaps on a higher time frame, and then use it in the context of a close proximity entry. So within about 5 pips or so of these lines, you can still find an overlap with setups that would be found on a lower time frame. Okay, so just in case you missed it, I'm still thinking bearish dollar. We could get a little bit of a correction. Doesn't have to, but I'd like to see it do it. But ultimately, I think we're going to 92. And here is the 15-minute time frame on the dollar index, and pretty much consolidating going into the close on Friday. Now, Friday was non-farm payroll, and we don't really do anything with that. It's been pretty much a continuing trend with non-farm payroll. It really was a rather moot point when the data hit. Ultimately, everything was just running in the same direction it's been with the narrative of the virus. Okay, so just as a quick interruption here, when you go on the financial websites, and this is barchart.com, I'm going to do 2 things here while I'm here. Number one, look at the splashes they have here. Okay, everything. Virus outbreak hits weekend Italian economy where it hurts. China trade slumps as antivirus controls close factories. Virus cases to top 100,000 in 90 countries as markets take a dive. Economic toil of virus sinks in. Duration remains unknown. So here we are. We're on the weekend. Okay, and this is what's being fed to the average investor. Now, does this bolster confidence? No, it doesn't. Okay, so now it's everyone's hearing about it. Anyone that's been on the fence about getting out of stocks or thinking about buying stocks, they're really being met with a great deal of negative news. Okay, so in normal situations, in normal conditions where we don't have pandemic situation like we have now, and I do believe it's pandemic, it's just the numbers are being, well, misrepresented. I'll just say it that way. The normal conditions would be, okay, we can go in and buy stocks now because it's maximum fear. Okay, you'll hear the people like Warren Buffett come out and say, well, right now everybody's scared, so when they're maximum fear, go in and buy. Okay, and when everybody's excited and feeling really good, that's when you want to sell. Well, that's kind of like Market 101. I mean, everybody knows that general theme, but this is something entirely different. This is something that isn't just a localized event. It's not affecting just one economy. It's affecting all of them. And to what degree and to what lengths will the damage be? I'm going to say pretty bad. Okay, I mean, we really could see something like a 75 to 80% complete collapse. That's where we're at with this. Okay, how the U.S. and other countries, mitigate this or make attempts to mitigate it, I don't know what the answers are, and I don't want to sit here and sound like I know all the answers and this is the way it's going to be, and we're all going to be destroyed as a result of it. I talked about it with my wife. I said, what type of things could you do to kind of like keep this from happening? Because we have airplanes coming in here from all over the world, and people have been shuffling around for months, cross-contaminating people. The cruise ship industry might as well just forget about it. It's done. I wanted to take a cruise with my wife this year. I'm so thankful that I didn't buy one, and because if I did, I wouldn't be going. And nonetheless, that industry is dead. It's just going to be so hard for them to win back the confidence of the individuals that go there. Unless you're just a diehard, I'm a cruise person, I'm an elderly person. If I get sick, it is what it is. Okay, those type of people will always go. Okay, and there's always the other type of folk that will just do things because they think everything is a conspiracy and there's no reason to be concerned about anything. They just blindly walk wherever. Okay, I'm of the opinion that these cruise ships are an indicator of what's to come, because nobody really wants to be a part of it as a majority. Okay, there's always going to be some that want to do it, and they're going to be lulled into with these really cheap tickets and boarding passes and such. But the problem's going to be that this isn't limited to cruise ships. It's also in airplanes. It's in your taxi cab. And I feel for those individuals, and I have a lot of them in my mentorship, that are Uber and Lyft drivers. I have been thinking about you all this week and how unbelievably scary this might be, because you're inviting folks in your car with you that may be putting you in danger, and your other passengers behind them, that when they slip seat with them, when they get in and get out and someone else comes in, your car, that's your car. That's not, somebody else's thing. That's your vehicle. And you're spending hours at a time every day in that. So without turning this into a podcast, okay, because it's very easy to do that, I'm just thinking about all of you and how this could potentially impact all of you. And I don't know, it's alarming to think how fast things are going to change in the coming weeks. If they don't get this under control, I think that we could really see nothing like we've ever seen in terms of recession. Like, this is collapse. Like, this is bad. Like, this is really, really bad. People are already clamming up. They're not trying to spend their money and going to events. NBA's talking about having games without spectators. I mean, folks, listen. If you've been on the fence, okay, and you've been laughing under your breath about the things I've been saying or tweeting about, look around. It's happening. Okay, whether you like it or whether you're prepared for it or not, it's happening. And the only thing I want you all to do is to be prepared for the worst case scenario. So that way, if you have the things that you can acquire, then at least you won't be stressing about that portion of it or part of it when the deepest part of this problem is going to be over top of us. I don't want to have anyone in here go through needless fear or just anxiety. I'm not anxious. I'm not trying to promote fear. I'm not trying to get you to try to lock yourself up in your house and all that business. I am personally an introvert, so this environment doesn't make me feel like there's any change required on my part. I've always lived like this. But other people that were very open and social butterflies, if you will, you're going to be cramped because there's going to be a lot of changes. If not just for the short term, there's going to be things that have to be put in place, and other things will be just simply a receding on the part of the public. There won't be any of these let's go out to these big gatherings, because it's just simply scary for them. Who knows who gets sick. And if we see transmission and community transmissions during the heat of July, June, and August, during the summer months in the U.S., you might as well pack it in, because that's the only hope everyone has right now, that warmer weather is going to kill it like it does the influenza virus. And I'm not of the opinion that that's what this is. I believe this is weaponized. I believe it was released, whether either by accident or intentionally. That's my personal belief. And again, it's not up for debate. I don't care to know what anybody else's opinion is. I'm telling you what mine. You paid to hear me. I don't care what anybody else's opinion is. And it sounds, narrow-minded and probably too myopic for some of you that are lofty in your own opinions. That's my opinion. Okay, I had all kinds of things going off in the fall that I knew something was coming, but either it was going to be a dirty bomb or a biological attack. And just go back and listen to my talks and look at the tweets. You'll see and hear me say those things. Okay, and here we are. And this ain't it. There's something else lingering. This is just the beginning of it all. And if you get wrapped up in all the fear, if you get wrapped up in what if, and it's always negative, you're going to make yourself sick, because ultimately you can't change any of it. The only thing you do is take care of yourself and your family. And the way you do that is get your essentials, get a little bit more than you would feel that would be able to cover like 2 months. If you can get 3 months, do that. If you have some savings, have some of it available in cash. And just have that in your home somewhere secure, where it's not like in a sock drawer or something like that. But just be prepared. That's all you can do, really. I mean, there's nothing you can't go out and change the world. But you also have to be prepared to see and expect things that you aren't used to. And it's going to be very scary for a lot of you. And folks that have normal anxiety, this is probably going to be very traumatizing for you. And as someone that has had anxiety in the past, I just know that you're going to do it to yourself by constantly listening to bad things. And if you're always listening to the news wires about this virus, it's just going to constantly feed it. So it's probably better if you don't pay attention to it. Just know that it's out there. It's probably in your area. And the only thing you do is hygiene to protect yourself, and teach your children and your spouse to do the same thing. And respect the family element. And if the family unit is thinking the same way in terms of hygiene and not taking needless risks in terms of exposure, listen, there's no movies out there that you got to go into a theater right now. Okay, there's no concert worth going out there infecting yourself. Okay, because everything that they're singing out there sounds better on a CD or MP4 anyway. So. That's just my view on it. Okay, so you make of it what you want to make of it. I'm just telling you that we haven't seen the worst of it yet. So while I'm here on bar chart, whenever you're looking at a commodity, and I'm going to use the S&P first, well, the only example really. You want to scroll down to the commodity, and once it gets to this page here, you don't need to go any further. All right, so the contract month codes, and you want to have this in your notes, for S&P is March is the first one of each year. It's H, okay? M is for June, U is for September, Z is for December, and then it repeats going into 2021. It does this every single year. The first two symbols is your symbol for E-mini S&P. The 2-0 is the year, just like it goes to 2-1 for 2021. Pretty obvious, pretty simple. Which contract do you follow, and or which one would you be paper trading? You want to look at the open interest number here, okay? March has 2,863,349. And then June has 188,094. When this becomes real close to one another, in other words, the numbers are just about the same, that's usually when I roll over into the next month out. but the easiest way to do it is whenever the next month is larger than the nearby contract. Okay, the nearby contract is right now considered March. Okay, because there's nothing earlier that's still active because it expired. December's contract that expired in 2019. So the first contract for 2020 was this March delivery. All right, so you're looking at open interest. When open interest on the next month is greater, that's when you should be in that next month contract and not following the nearby contract. The nearby contract will still trade, but it will be thinner, and you'll see the chart becoming a little bit more spottier and less liquid looking than the next month out, which would be June. Okay, so we have a little bit of time, a couple more days before this changes and becomes the leader in terms of open interest. That means there's more people trading it. There's more open interest in trading that particular contract in March than it is the June contract right now. Okay, and you can also see the volume reflects that as well. 3 million contracts versus 124 contracts down here. All right, so that's the business there. We'll get rid of that tab and this tab. All right, so let's go back into the Forex pairs, and now we're going to go into euro dollar. All right, and just as a quick note, I appreciate you guys working with me in terms of fluidity today. I'm not trying to be as rigid. I just want to kind of be fast and loose. All right, so the city here we outlined prior to price trading where it's at now. Admittedly, I wanted to see it trade down below these equal lows. I wanted to see it touch or just go below that, and that would be enough for us to use the institutional entry drill to get long on euro if the dollar supported it. Euro was having no parts of that, and dollar just falling out of bed sent euro right to our targets. Now, where we are right now, I am still bullish euro. I'm still bearish dollar, but I don't want to trade where we are right now. Okay, so we have a fair value gap in here. Be mindful of that with a bullish order block. We might need to come back down into that, and that would be around 111.90, 111.85. So watch that level in there. Any sensitivity around that 112 big figure could promote a willingness to go long. We also have a very large macro breaker. That means these up close candles in here. From this low and this low, there's your bullish breaker. So that would also be in line with working with that fair value gap and bullish order block. So around 112, 111.85 in that area. It could spike to 111.80. Anywhere in this vicinity from this candle's opening at 72, I really don't think it wants to go down that far. I'll stick with 80, 111.80 to 112 big figure in that area. There's something in there probably going to be bullish. We'll have to map that with time of day and day of week and market structure to support that as well. Maybe the economic calendar will give us something that would agree with that. But let's drop into an hourly chart. And here's the euro. You can see didn't come down, take out those lows. That's what I was rather more interested in. We have a BISI in here, institutional entry drill, gives you an opportunity to go long here. Same thing in here, fair value gap, institutional entry drill, long in here, price rallies. And look at the beautiful delivery of this euro dollar. I mean, how gorgeous is that? The bulk of the volume is always inside the bodies of the candles, not the wicks. And look at all of the bodies in here. Look how beautiful that respected that. Now, folks, you had this on your chart well in advance. And look at the reaction there. That's beautiful. Price could come down, rebalance to this point here. And again, that's another level we could just here and not get down to 112 big figure. It could just say, no, I'm simply not going down. Euro has been sleeping for a long, long time. And now it's awake. So we'll see if they want to send this thing a lot higher. Parity is off the table for right now. I know last 5 years or so I've been talking about parity between euro and dollar. This virus and the contagion across all global economies, I think has pushed that away, at least for now. So we'll have to revisit that later on if it's ever a point of interest for me to refer to. But right now, Strong euro, very strong. Drop into a 15-minute time frame. Okay, you can see the BISTs in here, buy side imbalance, sell side inefficiencies. It could rebalance to again the high here, 112.55. So 112.50, 112.55. Watch that level. That could be interesting. If we lose this and make an attempt to run below these lows here, I don't think it'll stop there. I think it'll go down into that 1180 level, which will be taking us down into this level here. And it would essentially also be about the midpoint equilibrium of this consolidation in here. All right. And again, just for clarity's sake, we're waiting to see it retrace. We don't want to buy it in here where it's at. It has to come back down into a discount. All right, let's go over to cable. Go out to a daily chart again. All right, so cable, I mentioned this level here. I said if we really broke down, we would see it trade here, but I changed gears on Wednesday. We ran below our lows here and here, so we took all the sell side liquidity out, and all of this area in here is balanced. Price went below, took the stops, and then Wednesday I said that we'd probably see it make an attempt to run and hit this order block here and run above these relative equal highs. And you can see we almost did that on Friday. I was almost certain that we were going to run into that and hit the order block. That still remains the objective. 130.52, and the low on this bearish order block is 130.84. So we're looking for 130.80, 130.85, and then the mean threshold of the up close candle here. That's the next target. I don't think it's just going to hit that and stop. Ultimately, I think we're going to go higher up here. They've held this thing for a long time. Euro has went into the stratosphere, and cable's going to probably want to get in sync with it, and that would send us back into the 135s for British pound. For those that are still paying from the UK, that's probably very good news for you. So moving on into the hourly chart, and let's fix this a little bit. All right, so we've had just a complete run higher, nothing of any real significant pullback. We only have one fair value gap in here that stands out, and scrunch this up just a little bit more. All right, so we have consolidation, break, distribution, redistribution, another level distribution. Smart money reversal, low risk buy, reaccumulation, and cleared that original consolidation out. Still looking at that 130.80, 130.85, and then the mean threshold on that bearish order block on the daily chart. That will be the objective, but we're still looking for a higher high relative to the daily chart. On a 15-minute time frame on cable, real nice reaction in here off of order block, fair value gap. Did not take the low out and showed a willingness to want to go higher. This is relatively strong. I mean, this has not had any kind of significant breakdowns. It's just really tight, just higher. Anyone that's trying to sell short this market is getting roasted. And why anybody would want to sell short with an extremely weak dollar, I don't know, but I've seen people on social media trying to do it. So again, focus 130.80, 130.85, mean threshold of the bearish order block on the daily chart, and then higher highs relative to the daily chart. I don't think that euro dollar is going to lead on the next leg. I think it'll kind of like pause. Still can go higher, but I think a lot of the momentum and magnitude is going to be in this pair. So we'll see what that does in terms of reality instead of just my opinion. All right, crude oil. Let's look at that real quick. I promised a couple of you. All right, so here's crude oil, and I'll just make this a little bit bigger. All right, so what we have is a tweet by me a couple months ago showing that there was relative equal lows, and actually let me zoom out a little bit more. I want you to see all these relative equal lows in here, and I said that we had a volume imbalance in here, it would want to run that. It did that, and it did so in shallow fashion. Okay, this drop down we called, it came to fruition. The sell side liquidity in here had been rated, but it was rather shallow. Then price comes right back up to what? What is it doing in here? We had a volume imbalance, but there's also something else there that it did not complete. A fair value gap. So here's a little bit of the narrative behind what I was saying and why I tweeted we would see oil below 42. All right, there we are. Right. Oh, I hate that it does that. All right, so I got this candle's low and this candle's high. There's your fair value gap. We also have a swing high, so we have buy stops resting above here and a point of imbalance. Price runs above that and then breaks lower. It breaks the relative equal lows and 1, 2, 3, 4, 5 relative equal lows. Lots of liquidity resting below 50. Price breaks below 50, and then we have a fair value gap right in here. Now, standard support and resistance, fellas and gals, would be looking at this. Support broken turns resistance, and that's why I believe it's a facade. There's lots of examples, lots and lots of examples of where you'll see support and resistance supposedly working. But if you really study what I've already taught you, you can actually see what's really going on behind the scenes in terms of rebalance, market structure, order blocks, all of those things, and fair value gaps. The narrative is much more clear, and it's not simply because it's going back to an old low and old high as support and resistance would convey or attempt to convey. It is not that easy. Believe me, if it was that easy, everybody would be rich. And look around, there's not a lot of yachts. Okay, not that everybody likes yachts, but nonetheless. All right, so the narrative in here is what I was working off of and why I felt confident enough to go out on Twitter with no net and say we're going below 42 on oil. There's your fair value gap on the daily chart. Okay, so with this in mind, we're going to drop down into, well, first, before I go into that, why 42? What was the level? Why did I call 42? If you go out to a weekly chart or a weekly view of it, we have an old low here at 43.50. Okay, so if it's going to go below 43.50, what's it going to reach for? 43. And for good measure, reach for another full figure at 42. Also, if you do this, if you type in CL, that's your code for the commodity crude oil. The the April contract is J. Okay, so the symbol for April is J. That's what I'm showing on here. But if you use the CL #1 exclamation point rather, sorry. If you click on that, it gives you a continuous chart that never really creates any spottiness. And you'll see that there is this low here, this low here, this low here, and then we have one right here. So that low is 39.19. Is that what it is? Yeah, 39.19 right there. Okay, so we have a low of 39.19. So we're basically looking at 39 below that. And then ultimately, if everything is what I think it is in terms of the economic slowdown, planes aren't going to be flying that much. People aren't going to be using a lot of oil. And that's going to create a heavy excess of supply. Real supply, not supply and demand, but real supply of oil. And they're going to really want to put all their oil on the market to get what they can get while it's above 38. And ultimately we could see it run below the 2016 low. And that is $29.40, what is that? $26 a barrel. So we're looking for $26 a barrel revisit of that. Unless something miraculous happens in terms of overcoming the coronavirus and it just doesn't pan out to be as bad as me and everyone else that's paying attention think it may, then obviously $26 a barrel is not likely to happen. But if it does continue on the same trend we have now, it's going to be real easy for it to get down to $20 a barrel. What? You just jumped from 26 to 20. Yep. Always the best case scenario. You always have to have that in your trades, folks. All right, so anyway, we had the CLG. Here we are, April contract. And I'm going to drop down into the hourly chart and zoom in this little boy. And scrunch it up. Alrighty. So we are looking at price working inside that fair value gap. And price, if I'm not mistaken, I think it was, where was it at here? Right about there is when I sent the tweet. So it was inside this candle right here. So what you'll have to do is consider what you would do as a trade. You can take the trade at the bearish order block here, which is the last up close candle with a body right there. So that would be this. This is the taken entries portion of the crude oil commentary. All right, so I don't like that. I appreciate the folks that told me about this. Hold down shift while you move your trend line around. It snaps it to flat. That is an answer to OCD prayer. So you could be a seller here. Stop has to be above here. And now think. Some of you are already thinking, well, why want to go up here and fill this fair value gap in here, Michael? Why would it need to? Because we've already left this old support line. See, you're thinking support and resistance theory. It's going to get too close to that. I'm not a subscriber to support and resistance. Okay, so the fair value gap that's blocked out here is relative to the daily chart. That's going to be more significant or have more emphasis or power and control over price than this little one here that's above what is required only for the daily chart. So banks and large institutions, they're working off of the daily levels, and then the smaller time frame levels are not going to be that significant. So you have an opportunity to go short here, and multiple times here, or at the top of the fair value gap again, and or wait for a fair value gap. Once it starts to break down, you have one right in here. And there's your institutional entry drill right there. So because this candle's high is 47.49, it needs to trade just to that price to go short. The next candle's high is 47.54, so 5 points above it. And then we have multiple opportunities in here. And then it breaks down, returns back to the bearish order block here. But look what it's doing. It's allowing all of this time for traders to get in at a fair value of $47 to $48 a barrel. Price breaks down. Bearish order block here. Fair value gap, institutional entry drill here. Fair value gap, consequent encroachment here. Reaches down into 42 and all the way down almost to 41. Went down to 41.05, I think. Yep, 41.05. Beautiful price run on oil. Now, every 47 to 46, that's $1,000 per contract. That's what you're earning. Or if it's moving against you that much, you're losing that much. Okay. While I tweeted about $6,500 a move in oil, you got to go back to what we were talking about in the mentorship, and that was back here. So it's actually like $12,000 per contract. So anyway, that's just for your edification. And let's see, I want to talk about the lesson for this week. And it will be started with, what did I start it with? Oh, I told you to go into the individual commodities or currencies. Okay, and this is the symbol for the Euro futures continuous. The way you would get it up normally would be number 6, the letter E for Euro, and then you would put in H for month delivery contract March, and then 2020. Okay, so I don't want to change the chart here because it'll mess up my whole flow here. But I'm using the original, not the original, but the continuous chart setting. So 6E number 1 exclamation point. Okay, and it's really nice to be able to have that on one chart, because then all you got to do is change the E to a B and you'll get British pound. If you change the E to a C, it'll be Canadian dollar. If you change the E to a J, it's Japanese yen. If you change it to an N, it's New Zealand dollar. A is an Australian dollar, and then I think I've covered it all. S. If you change the E to an S, it's the Swiss franc, and you'll see all those charts anyway. All right, so I have the 20th of February here. Why do I have that there? What's so significant about that? That is the high of the dollar index. That's when we created the high in the dollar, and it met two of our objectives on the upside in terms of a premium array. Didn't quite close up everything I wanted to see in the dollar, but that's how it goes sometimes. Sometimes you have an epidemic around the world that's wiping out the population, and the end of the world's coming, and then tends to change the charts a little bit. But here we have the 20th of February. Okay, now I'm going to go a little bit slow here because I want you to think about what I'm saying, because this isn't the only lesson. We're going to be doing this all month. Okay, so you have this coming Saturday's lesson on the cross manipulation and delivery, because that's what we're teaching here. The idea is for you to slowly arrive at the answers that I'll still supply in the last lesson before we close out March. And that's not all I'll be talking about it, but I'm just introducing more meat to this concept because it's one that is really rich in terms of treasure hunting. All right, so assuming that we were comfortable with doing reversal patterns, which, as you can see during this mentorship, I have kept you all away from that and only working within institutional order flow and staying with the primary macro trend. That is to your benefit, because if you don't have a lot of experience, you can really get yourself hurt. You'll marry a vein. In other words, you'll fall in love with an idea, and you'll keep doing it and doing it and doing it, and you'll either blow out your account or create a toxic thinking about analysis. And I know that from personal experience multiple times. I did it dozens of times in the 90s, and I've since learned the best times to do reversals. And I know some of you are saying, well, if that's the case, Michael, then why didn't you put us in longs on euro? Because I'm teaching independence, not codependence. Again, the folks that want spoon-fed here are going to have the most difficulty. The folks that are here to learn, they learn and they get it. But if you're demanding or trying to twist my arm into giving you cookies every week, buy here, sell here, you're not going to learn doing that. The only thing you're doing then is learning to trust me only and not your own analysis. And I'm giving you all the tools and concepts that I use to do these things when I'm right. You can see the same thing will happen in your analysis over time, but you got to let that happen. You got to let it develop. We will get into reversal patterns, okay? But there's things that you have to learn that leads to trust and navigating those environments. But I want you to consider what I'm going to show you in the charts. Now, you're going to want to watch this portion of the video multiple times, because unless you do that and also look at your own charts, you're not going to get what you should be getting from it, because it's going to require a lot of time and study on your part. Me referring to certain things is just going to be like, okay, well, he's just talking about it because it's hindsight. No. If you remember anything I taught about relative strength analysis, okay, I did free lessons on that, and I did it in some of my YouTube videos that I don't even recall where they're at, because I did so many videos and I didn't really do a good job of, logging what was being in them. So I don't know. I just simply don't know. I got thousands of videos I've created, and some of them are just loaded with information that I just don't remember where I put it. So the folks that are diehard constant readers and viewers of my work, you'll know what I'm talking about when I'm talking about relative strength analysis. I'm not talking about the indicator. Okay, I'm talking about comparing highs and lows, like in an SMT format. SMT is Smart Money Tool or Smart Money Technique. Okay, it's not some group on Instagram. the smart money team. Okay, these posers. The idea of looking at how markets are compared on a relative strength basis. So what do I mean by that? The idea is we want to look for, number one, when is the market predisposed to go higher as a whole? Okay, because the idea is this: in high tide, all boats rise. Okay, that's the idea. And in low tide, all boats sink. They go lower. Not sink under the water, but they go lower. So as the tide of water goes up, any boats in the water that are floating will rise with it. And any boats that are in the water, when the tide goes lower, they'll go lower as well. Okay, so we want to be focused on the leadership issues on both sides of the spectrum. When the market is predisposed to go higher, okay, and what do I mean by that? If the dollar's bullish, all other foreign currency by default should go lower. That's just the natural order of things. If the dollar is bearish, all foreign currencies should go higher. Again, that's just a simple natural order of things. But we do not just indiscriminately assume that all currencies will rise in equal basis. In other words, there's going to be a exaggerated run on one or more currencies than the other, and that's leadership. Okay, and what that is, that's institutional sponsorship. So this is for your notes. If you're not taking notes, then you're wasting your money and your time. I already know this stuff, but if you're not being adamant about taking copious notes, you're wasting your time here. But institutional sponsorship is where you'll see specific currencies or assets. It could be in stocks, it could be a certain industry group and certain stocks within an industry group that outperform the index, the S&P going higher if it's bullish. You want to look for strong leadership issues, and that's going to be found in strong underlying industry groups that have existing trends, that have moved back to a fair value or cleared out some sell-side liquidity, and now they're ready to go higher. All those same theories can be applied to currencies, but there's some subtle nuances that I'm introducing here that I haven't done before. So we have the low on the euro, basically delineated with the high that is on the dollar index. So February 20th, we created the high in the dollar index, and it's basically dropped since then. So if we were astute enough and versed enough to take reversal patterns, and we were expecting weakness on the part of the dollar, which currencies would we be interested in buying? This is a real big point here, okay? This mentorship of mine, the ICT mentorship, what is it that I'm teaching you? If I had to answer it in one sentence, okay, if some neophyte came to me and said, hey, look, I'm interested in your mentorship, what is it? My response would be, I teach people how to read price, how to look for internal range and external range liquidity, and how to marry those two ideas with market structure. So there's a lot of other things that I know, but you only need to know one facet of what I just said and not know all of it and do extremely well. What I want you to recall is this. One of two things are happening 99% of the time in the marketplace. The market is running to a fair value, or it's running out liquidity for the basis of accumulation or distribution. That's the only things that's happening. So my mentorship teaches you what to see and anticipate in those environments and how to facilitate an opportunity and engage that with price action. Now, notice that I did not say I'm teaching people how to trade profitably, because I can't promise that. Legally, I can't do that. That's why I talk about price action. That's why I don't do live here, get in right now, put a stop. I can't do that. I can't market that way because I stay within that safe zone, not because I'm scared, because you clearly see I know I can do this stuff. But I do it to protect myself, because the Commodity Futures Trading Commission would love nothing more than to hang me by my ankles. Okay? So I do what I do in the safety of limitation. All right. But the individuals that know how to read price, at some point, they themselves, yourself, will get to the point where you can see what price is doing before it happens very, very consistently. And as long as you manage the risk in doing so, you stand a good chance, not a perfect chance, you're going to lose money, but you stand a good chance to find success in this on your own merit, not mine. See the difference there? So I am not trying to teach you to trade. That's not what this is. I'm showing you how I trade and how I internalize the marketplace. But what you do with your own trades, should you ever decide to trade with live funds, that's entirely up to you, and it's your responsibility, not mine. So I just toss that out there as an answer to an email before we get into this. But nonetheless, because we're looking for internal and external range liquidity, and we're also looking for fair value, they're the only two things that this mentorship teaches. That's it. Now, there's a lot of conditions. There's a myriad of things that line up to prevent the market from providing an opportunity that would also provide an opportunity for us to do the opposite of what retail would expect. So there's a lot of different angles that I'm teaching you, and your job is to find which one resonates with you the best. Now, with all that said, put aside, just know that your primary goal is to determine what is internal range liquidity, external range liquidity, fair value. Those three components is what I promise in teaching this mentorship. When I'm done teaching mentorship content, and we're just only doing reviews, and that'll be post 2022. In 2023, it's just me saying what I think is going to happen in the marketplace and then reviewing it. There's not going to be any more new lessons. So everything I'm ever going to offer will be finished at that point. But your goal, and it's always been this way, is to determine and understand internal range and external range liquidity and fair value. The market is always gyrating from those two primary functions. But the one in terms of dealing ranges is working within a range or working outside of a range. Okay, and the mentorship covers that. So with that in mind, I want you to look at price as we go through these individual currencies. And again, these are the futures prices. This is not Forex. Okay, so these are actually the commodity contracts for Euro futures. Okay, they're going to move very similar to their respective pairs unless it's an inversion of what we would see. In other words, like the dollar CAD. When we look at Canadian dollar futures price, that is actually an inversion of what you would see in the price of the dollar CAD pair in Forex. Okay, so some subtle nuances there. But we have euro dollar trading down below relative equal lows at the time it trades to February 20th's low. Also, we were in 2, or I think it was 3 pipettes from an actual target of 1.0777, and it went down to a low of, and yes, this is some shameless plugging. The low on this is, what is that? 1793. I thought it went lower than that. Oh, yeah, I'm looking at the futures contract. I confused myself there. See how easy it is to confuse yourself? So on the futures contract, the low went down as low as 10793, and the euro dollar pair went down to, I think, 1.078 or something like that. It didn't quite get all the way down to my 777 level, which is what I was anticipating. But we were in an area where it could potentially reverse. If you go back and listen to the recordings, that's what I said. I said, look, can it reverse? Yes, it can. But we stay with the narrative because I'm teaching you to track the large institutional flows on one side of the marketplace. Reversals are entirely something different. But in this area, I said that we can, because that is a condition that would lead to a rejection and reversal on a long-term front. Don't take my word for it. Go back and listen to the recordings around that same time. So what we have here is the market reaching to a discount array on a higher time frame weekly chart. We ran out liquidity below these lows. And at the same time, the dollar is being met with multiple premium arrays as upside objectives. And we have a world pandemic. All right. This pair, or this currency, is extremely oversold in the real sense. And it's likely to see short covering and new buying because of where it's at. Now, the narrative I'm trying to outline is that we have completed a run on sell side liquidity and basically almost to the point of perfection ran to a lower level objective that would constitute a long-term low, possibly, quote unquote, possibly forming in euro. Okay, so if we look at the market structure here, this is a setup. If you looked at this on, and they say this was London, okay, and all of this price action was an Asian range of, say, the British pound, not the euro, okay, and I'm probably going to confuse some of you. Just listen, okay. All this consolidation and initial run above, and then breaks down, takes the sell side liquidity out, and then creates the low of the day and rallies higher. That same fractal is the same thing I teach in this mentorship. Same thing. Your objective is to see how that would pan out on a higher time frame like this, because we're looking at daily charts now. This is an area where it could potentially present a buying opportunity. By itself, it means nothing, but you have all these other things and factors coming into the play. It is highly probable that this particular currency can rally. Now, watch what we do when we go with the other currencies. So right away, this is a pair that is bullish. If we look at Canadian dollar, at the same time, Canadian dollar was here, okay, and had it ran out its lows? Not yet. Has it gone down to this fair value gap here? Not yet, on the 20th. So this pair, or this currency rather, is futures contract on Canadian futures, because it had unfulfilled objectives and unfinished business with liquidity here and rebalancing to a fair value here. So this currency is underlyingly weak in contrast to euro. It has yet to go down and clear its liquidity or reach upon a fair value at this point. Okay, so right away, Canadian dollar is moving lower while euro is going higher. So right away in your list, in your notes, euro strong. Currencies that are weak right now, we've already seen Canadian dollar is weak. What can you do with that? Well, your homework is to look for a pair that uses both of those currencies. I'm not going to do that work for you. And then I want you to study what it did from February 20th to last Friday. Moving over into British pound. All right, British pound is more or less a wild card because we have been watching this pair for months and it has been performing like it doesn't even want to pay attention to anything. It doesn't care what the dollar's doing. It can go higher or lower. It doesn't care. Okay, so this particular pair, we have relegated it to, it's in consolidation. It's a don't touch right now. Okay, in terms of previous analysis. I know in this recording I said we're probably going to reach up and take out this high here, maybe up to here. That's based on what I have now after running this low and this low. But prior to that happening last week, we've been pretty much reluctant to touch this pair. And look what it's done. It's pretty much stayed in a range and hasn't done too much of anything. So we really don't want to look at British pound and have a bullish or bearish. It's just a neutral pair. We don't consider it at all. Japanese yen. Japanese yen on February 20th, look what it did. It ran down and took out equal lows. Well, it ran liquidity at a time when, if we were astute in looking for reversal patterns in the dollar index and higher time frame reversals, weaker dollar would suggest that the Japanese yen would go higher. Yes? Can this pair go higher at that moment on the 20th of February? Yes, it can. Why? Because it went below old lows. So it has tapped into sell side liquidity, so it's reached a real discount array, and it can now move higher. Now contrast that with what I said in regards to Canadian dollar. I already know some of you are like, okay, this is going too fast and I'm not getting this. This is the reason why it takes a lot of work here, folks. Okay, you're gonna have to watch this video multiple times, and there's other supportive lessons that are coming that will help you. Okay, but just know that this is what is required to understand these things. You got to do a lot of compare and contrast, studying, reflecting on certain things, and understanding specific components intimately, and then how they fit together. Those 8 lessons that you're watching over each month, that's not mentorship. That's not mentorship, and I'm telling you, I could literally put them on my YouTube channel and make them public knowledge, and it will not help anybody figure all this stuff out. It's just a language. Okay, this is where the teachings are occurring. So because on the 20th of February, we had unfinished business down here. Sell side liquidity has not been tapped. We did not go down to fair value. Remember I told you that that's what this mentorship teaches you. External range liquidity. What is that? The external range is here. What do you mean by that, Michael? Well, we have this low to this high. What's outside that range on the low end for a discount? It's below these lows. We have relative equal lows, and then we have close proximity, relative equal lows. All of this has a huge pool of liquidity in the form of sell side below it. So this low to this high, external range in the form of buy side liquidity would be above here. External range liquidity in the form of sell side liquidity would be below here. At this point on the 20th, it has done neither higher than this high or lower than this low. So is this likely to go higher in relationship to a weaker dollar as it would be normally? No. It has unfinished business and has not done one of two things. It has not traded to external range liquidity or traded to fair value. It has now since done that. But it didn't go up in relation to the dollar going down. Think. Okay? Big lesson. Japanese yen, we did take out the lows, so it is now okay and free to go higher. So we have a strong currency in the form of Japanese yen. We have a strong currency in the form of euro. We have weak currency in the form of Canadian dollar, and British pound is neutral. Let's go over to Swiss franc. Okay, here's the Swiss franc. Here's the 20th of February. That's when the dollar made its high. Okay, what's happened? Has the Swiss franc on the 20th traded to below sell side liquidity or a form of fair value? Yes. We have a gap here in the form of fair value that would be rebalancing to that point. We have taken out equal lows, and we've already had a stop run down here. See all these lows in here? We've rated that, and the narrative has been what? Bullish. And all this was a retracement back to an underlying bullish market. So we have a strong currency in the Swiss franc. So in your column for strong currencies, you have Japanese yen, euro, and now Swiss franc. Weak currencies, we have Canadian dollar, and one neutral that's not in any other category is the British pound. All right, Australian dollar. We have Australian dollar. We have relative equal lows in here. On the 20th, we had just stabbed through that. We had just stabbed through it. But this pair, now this is where we start having a little bit of subtle nuances, because now remember, I tweeted a short condition around that, was it 67 in this area here? I tweeted, what do you see? And gave you the reasons why it was going to go lower. Look real close. Look at these highs. As we were going into that here, this contrast with Canadian dollar. Look at that. Canadian dollar is going higher. Aussie, I can't do it. I'm just tired. I can't do it. Okay. Underlying weakness. Extreme weakness. Same thing. I'm going a little bit ahead of myself, but I want you to really see it. Here's New Zealand dollar. Same thing. Really just unwilling to make a higher high. It's just absolutely weak. Okay. Really weak. Aussie dollar. Right in here, we had just moved shallow below here. And on the 20th, we really went below it. But it has underlying weakness. really big weakness. And also, this has been the leading weak pair for months in all the Forex pairs, in all the foreign currency rather. Aussie dollar has been the weakest of them. And this is just an opportunity to go lower. And we saw that. So we have a weak currency in the form of Aussie, and we have a weak currency in the form of New Zealand, the same thing. Weak going into the 20th, you can't even make a higher high, and it's just every low is able to make a lower low, and we have unfinished business. We have sell side liquidity pool here, and we have relative equal lows, which has since been traded to. In Aussie, we had really clean lows here with a shallow run below that ahead of the 20th of February, where it made the high in the dollar index. This should have seen it go higher. It was underlyingly weak. That's why I tweeted, what do you see? So you can see that this pair had really more room to go lower, and go back and watch the recordings where I gave even more insights about that at the same time around mid-February and where we reached to. So we have New Zealand dollar, Aussie dollar, and Canadian dollar as underlyingly weak currencies. Strong currencies, we have euro, Japanese yen, and Swiss franc. British pound, not so interested in. So now what I want you to do is I want you to compare and contrast. This is your homework going into next week. We'll review it in Wednesday's recording. What pairs can you make using the strong versus the weak, or the weak versus the strong in Forex with that list of currencies that I just outlined? Okay. And then once you decide what they are and determine what they are, and you'll see right away that there's huge moves taking place because you're comparing the strongest against the weakest, or the weakest against the strongest. And knowing directional bias in those instances will give you those 500 to 1,000 pip swings. All right. So I will build on this as we go through the remainder of this month. That's your homework. Watch this portion of the video multiple times. And again, if you don't feel like it's clicked yet, we still have lessons this month, and there's also content in the mentorship as well. Until I talk to you again, I wish you good luck and good trading. Be safe.